Hi, welcome to Dig Into China. I'm Dong Shang. October 1st marks China's National Day, kicking off a week-long holiday. On the final trading day before the break, A shares skyrocketed, with the Shanghai Composite Index hitting its largest single-day gain since October 2008. Truly a significant gift for the Communist Party's National Day. Now that we are in the fourth quarter, what's next for A shares and what signals might suggest they've reached their peak? In today's video, I'll dive into how much longer the rally in A shares might last. First off, it's widely agreed that this surge in A shares is unrelated to economic fundamentals. Those flooding into the market are acting with a gambler's mindset, confident they will know the right time to exit and thinking they can cash out before the real reckoning begins. Yet, the long history of A share market wipeouts tells us that investors' confidence is misplaced. I often compare A shares to a casino. In truth, only 10% of people consistently make money in the Chinese stock market, while 90% of investors lose out. At least in a casino, when you are betting big or small, you still have a 50% chance of winning. In that regard, A shares are even worse than a casino. I came across some data showing that in the past few days, over 70% of new brokerage accounts have been opened by people born in the 90s and the 2000s. It got me thinking, maybe every generation needs at least one personal experience of being harvested by the A share market. Our generation lived through the crashes of 2008 and 2015. But the 90s and the 2000s crowd haven't really felt the impact of those disasters. They likely need to face the party's side themselves before they can truly empathize with us. Otherwise, no matter how much you try to warn them, they just won't listen. If you take a look at the recent surge in A shares, you will see that various financial media in China are proclaiming this time is really different. The focus on different aims to discourage you from relying on past experiences of A shares harvesting investors to protect yourself against the current scenario, essentially urging you to enter the market quickly. However, I must emphasize that A shares have never changed their fundamental purpose. They exist to harvest investors. Right now, the Communist Party is propping up the stock market to bolster the confidence and expectations, fully aware that simply handing out money to consumers won't be enough to stimulate the genuine demand. In the current economic climate, when people receive cash, they tend to use it to pay bills and repay debts, which doesn't really enhance expectations. However, boosting the stock market, a key symbolic indicator, has substantial symbolic significance and can create a major impact on public sentiment. The Communist Party only needs to prop up the stock market for a period, and then the short-sighted and greedy investors will start to feel two things: inflated confidence and FOMO, fear of missing out. Inflated confidence leads investors to spend more, directly boosting economic growth. It's a small effort that yields significant results. Conversely, FOMO drives investors to rush in with their hard-earned money. This way, their funds are ultimately drawn out. Once investors pour their money into the stock market, the central bank's funds are fully returned, with the investors' money split, 70% going to the Communist Party and 30% to speculators and institutions. Does this scenario sound familiar? Naturally, there will be a competitive process at play, and whether or not you trade stocks, you can easily understand what's happening. It's quite interesting, and I'll get into that later. For now, let's quickly go over the technical aspects of stock market financing and government debt. First, let's discuss corporate financing, which typically falls into two categories: indirect financing, where a company borrows from a bank, and direct financing, which involves becoming a publicly listed company. It's essential to remember that the stock market provides a platform for companies to raise funds, and the benefits of direct financing far exceed those of indirect financing. For example, let's say a public listed company intends to raise 100 million yuan through a private placement. What would the costs be for this placement? The total expenses, including issuance fees, legal fees, and auditing fees, could amount to around 2%, which totals 2 million yuan. On the other hand, if the company opts for a bank loan, even without considering collateral, a purely credit-based loan from the bank might cost over 3%. Thus, private placements are the more economical choice. Secondly, when you take out a bank loan, you need to make regular principal and interest repayments, and it is classified as a liability on a company's balance sheet. On the other hand, a private placement only increases the company's equity, which shows up as an increase in owner's equity on the balance sheet while keeping debt levels the same. This can effectively lower the company's debt ratio. To put it simply, money borrowed from a bank must be repaid, but funds raised from the stock market don't have to be paid back. This creates a prime opportunity for companies to take advantage of investors. When we talk about debt, we must also consider government debt. It's well known that the local governments are in a severe financial crisis, with many on the brink of bankruptcy and resorting to extorting private entrepreneurs. Thus, a significant surge in the stock market is a tremendous aid for them in managing their debts. In fact, half of the market value in the A-share market comes from state-owned and central enterprises, and nearly every local government has stakes in or controls publicly listed companies, all of which are classified as state assets. As of the end of 2023, there are 1,008 publicly listed companies under local state-owned assets. This enables local governments to leverage these companies to raise funds in the A-share market and refinance local debt. For example, consider a local bank where the primary shareholder is the local government treasury. In recent years, local governments have had to issue bonds to inject capital into this bank. However, the landscape has shifted. With a substantial influx of funds into the A-share market, bank stock prices have soared, resulting in increased valuations. As a result, local governments can permit this listed bank to conduct a private placement in the stock market to boost its capital. This means that the local governments can avoid issuing additional bonds for capital injections, effectively replacing a portion of their local debt. The Communist Party's approach to driving GDP growth in the fourth quarter is fundamentally similar. The estimated highest GDP growth rate for China in the third quarter is around 4.6%. Consequently, to achieve the annual target of 5% GDP growth, substantial investment is needed in the fourth quarter to generate at least 5.4% growth rate. It's well known that the Communist Party's strategy for boosting GDP hinges on one crucial factor: money. If this money can be sourced from the stock market, government debt won't increase, creating a win-win scenario for the party. Thus, I can confidently predict that in the fourth quarter, numerous state-owned enterprises will initiate private placements. They will utilize the funds raised from the stock market to support various projects aimed at enhancing GDP, such as infrastructure, high technology, and semiconductor manufacturing. As long as the funds are poured in, there's no need to worry about GDP growth. Thus, the recent daily increases of several points in the stock market cannot continue indefinitely until the end of the year. A correction and some fluctuations are bound to occur. Otherwise, the Communist Party will struggle to source funds for boosting GDP in the fourth quarter. However, I don't think that a state-owned enterprises launching private placements to stimulate the GDP will instantly push the A-share market into a bear market. This is unlikely to happen, as the central bank can intervene at any moment to prop up the stock market. The A-share market's harvesting on retail investors strategy consistently plays on psychological manipulation. Let's break it down. At the beginning, institutions aggressively pushed index up, just like the market rally we saw at the end of September. With records being shattered every day, they create a rapid surge that leaves investors bewildered. The objective is to break the retail investors' resolve. If they don't jump in, the market will keep rising, pushing them to act out of fear of missing out. On the first day of a surge, you might think this is just a short-term trend and expect a drop the next day. By the second day of gains, you are still cautious, choosing to observe. By the third day, you start worrying that you've missed out. On the fourth day, you are already thinking about pulling out your savings to jump in. By the fifth day, as the rally continues, you can't hold back any longer and rush into the market. Then the second phase begins. The market climbs back to previous highs, allowing many trapped investors to break even, and a new round of market gains unfolds. Some investors think, I'll sell as soon as I break even, I've been stuck long enough. Others believe the Asia market still has room to rise, so they hold on to their stocks. As a result, some money will leave the market, causing a brief shake-up. But then the big players will drive the market up again, making those who exited regret their decision and forcing them back in. If Asia investors were truly rational, the Communist Party would keep pushing the market higher. Because the retail investors haven't taken the bait yet, there is a significant information gap between individual investors and the national team. It's like playing a card game where they can see our hands, but we can't see theirs, giving them the upper hand to exploit our psychology. When you think you'll sell as soon as you break even, they'll continue driving up the market, making you regret your early exit. As long as you feel like you are missing out and start to second-guess yourself, watching the market rise daily will eventually break your resolve, pulling you back in. Here is a real story about a social media blogger who worked in banking during the 2007 stock market frenzy. Back then, the A-shares were surging daily, with the Shanghai Composite Index hitting a peak of 6,124 points. The blogger described how bank branches would have long lines of retirees all bringing their life savings to buy stocks and mutual funds, their eyes filled with excitement of the boom. One day, her father, who had always been indifferent to investing, suddenly mentioned to her mother that he wanted to buy some stocks and mutual funds as well. That's when she knew the stock market euphoria was about to end. Her father, a person completely detached from financial matters, was finally swayed by the hype, which was a clear signal that nearly everyone who could invest had already entered the market. As predicted, by 2008, the Shanghai Composite Index crashed from 6,000 to around 1,000 points, leaving countless people in financial ruin. The same principle applies when assessing the future of the A-share market. Check in with your friends about their investments, how much they have in the market, whether they've taken profit or if they've sold and re-entered. Observe those who typically ignore the stock market, especially the more cautious individuals, and see if they are starting to get interested. When you see cleaning staff and delivery workers queuing up to open brokerage accounts, it's time to consider withdrawing your funds. This indicates that all potential new investors have already entered the market, signaling that harvest season is near. Based on past trends, I believe the Shanghai Composite Index will stay above 3,000 points by year end, with the upper limit depending largely on investor sentiment. The central bank theoretically has the power to influence the market as much as it wants, but to ensure that state-owned enterprises can effectively raise funds through the stock market, it will likely focus on managing expectations. Consider this. The central bank hasn't issued any documents or invested any money yet A-shares have already risen significantly. This clearly illustrates the power of expectation management. The People's Bank of China the ultimate goal is to achieve significant outcomes with minimal investments. When the central bank puts in 1 yuan into the stock market, state-owned enterprises can ultimately secure 10 yuan. This method is much more effective than simply injecting liquidity into banks and allowing them to lend to state-owned enterprises. As noted earlier, funds raised through the stock market do not require repayment. Therefore, if Chinese investors choose to dive into the Asia market for profit this time, it's essential to keep the right mindset. Once the index surpasses 3,000 points, they can sell at any time. However, if they exit, they should refrain from re-entering. It's also advisable to avoid any news or social media discussions about the stock market to steer clear of being taken advantage of. If you are thinking about jumping into the market at this point, it's vital to have a clear understanding of your situation. If you find yourself among the last wave of retail investors entering, you might discover that getting out isn't easy once you are in. It's equally important to establish a profit-taking strategy. Set your target before you invest. For example, if you aim to make 10,000 yuan, stick to that goal and follow through. Don't let greed take over, and you may still find success. Always remember, never try to grab the last penny. You can't outsmart the institutional players. Additionally, understand that the primary function of the Chinese Asia market is to finance state-owned enterprises. Retail investors will always remain just that, retail investors. The Asia market lacks genuine autonomy. Everything is controlled by those in power. Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. I'll be back with more content soon. Until then, stay well.